unearned or deferred revenues, which you recall represents an obligation on the company to provide future services or transfer goods in the future. Other examples of current liabilities are short-term notes payable. That is short-term debt that will be due in 1 year or the operating cycle, whichever is longer. Now, long-term liabilities are obligations that will not be satisfied in the next year or the operating cycle, whichever is longer. And under long-term liabilities, we have notes payable, which is a long-term notes payable. We could also have bonds payable being reported under long-term liabilities. Now, turning our attention to shareholders' equity, we recall that shareholders' equity is the residual interest in the assets of a company that remains after we deduct liabilities. So, stated another way, we can say that stockholders' equity equals total assets minus total liabilities. Now, the two components under stockholders' equity we see here are common stock, which represents contributed capital, and retained earnings, which represents earned capital. Again, common stock represents the amounts invested by shareholders, and retained earnings pretty much represents the accumulated net income reported since the inception of the company, which has not been paid to shareholders as dividends. Now, let's examine some of the assets accounts more closely, and we'll start off with account receivable. Now, accounts receivables are amounts owed by customers that we expect to collect. The balance sheet reports the estimated net account receivable. For the account receivable reported here as 97,100, it actually means that the gross or total account receivable is 100,000 and less the estimated allowance for uncollectible of 2,900. We subtract that, gives us 97,100 as the net AR or account receivable we expect to collect. So it's the net amount, again, that is reported in the balance sheet. Now, note that when a company increases its allowance for uncollectible accounts, what happens is that it also records bad debt expense in the income statement. Now, note that as we see here, the allowance for uncollectible is subtracted from the total account receivable to give you the net account receivable reported here. So the allowance for uncollectible is a balance sheet account. Now, the counterpart to the allowance for uncollectible is the bad debt expense. So when a company increases its allowance for uncollectible, it also records bad debt expense in the income statement. Note that if a company overestimates the allowance account, bad debt expense is too high. And what happens is that net income becomes understated. Now, in future periods, when a company does the overestimation, the company will not need to add as much to its allowance account as it has already been overstated. The other option will be that it can reverse the excess existing allowance. But then future net income will be higher. Now, this suggests that the allowance estimate can be used to shift income, shift profits across periods. It can be used to manage earnings or manipulate earnings. Now, if a company underestimates its allowance account, then current net income will be overstated. And what will happen is that in future periods, net income or profits will be understated as the company must add to the allowance account and report higher bad debt expense as the accounts are written off. This again illustrates the point that the allowance account, either underestimation or overestimation, could be used to manipulate earnings. So as we can see, given our gross balance of 100,000 and estimated uncollectible accounts of 2,900, accounts receivable is reported as 97,100 net amount. The accounts receivable turnover rate reveals how many times receivables have been collected during the period. More turns indicates that receivables are being collected quickly. The average collection period measures how many days on average that it takes a company to collect its receivables. Now, we would like to calculate accounts receivable turnover ratio and the average collection period to confirm that a company is effectively managing its receivables and that the receivables are of high quality. So let's say you work for a bank and a company comes in for a loan. You should be interested in confirming that the company is effectively managing its receivables so that as the lender, you have greater assurance of payment. Now, note that an increase in average collection period implies that customers are taking longer to pay amounts owed. And this might be due to customers weakening credit quality. Now, inventory at the end of the period is valued by making an assumption about the flow of inventory as it is sold, and it becomes cost of goods sold in the income statement. Now, recall that inventory in the balance sheet flows out when inventory is sold, and it flows out through the income statement as cost of goods sold. Now, we assume a cost flow for the inventories, which may not be the actual flow of the inventory. Now, an example of a cost flow assumption is FIFO, first in, first out. Now, in most circumstances, the first in, first out assumption closely reflects the physical flow of inventory. Now, we can say that first in, first out physical flow is critical when inventory is perishable, or in situations in which the earliest items acquired are moved out first because of risk of deterioration or obsolescence, such as technology products and retail items. Now, companies are expected to use a cost flow assumption that mirrors the actual flow of inventory into cost of goods sold. Note that if inventory costs are rising, first in, first out, FIFO, yields higher ending inventory. Now the reason is that the last inventory coming in will be at a higher cost from our suppliers. So first in, first out, when inventory costs are rising, will yield higher ending inventory values. And it will also yield the lowest cost of goods sold. Recall that first in is the first out. And it will also result in higher net income compared to the other inventory valuation methods, such as LIFO and average cost methods. Now, after the value of ending inventory has been determined, we can calculate cost of goods sold using the following formula. Beginning inventory. Now, note that the beginning inventory is the ending balance of the prior period. So for example, beginning inventory for 2015 is 2014 ending inventory. That is the inventory in the 2014 financial statement. So beginning inventory plus inventory purchased, if we are analyzing a retail company, or inventory produced, if we are analyzing a manufacturing company. Now, inventory purchased or produced is added on to beginning inventory because that goes into storage or the shelves of a company. Now, minus ending inventory should give us the inventory that were sold, that is cost of goods sold. Let's now look at some ratios used to analyze inventory. We'll start off with inventory turnover ratio. The inventory turnover ratio reveals how quickly inventory is turned or sold by the company. More turns indicates that inventory is being sold quickly. And inventory turnover ratio is calculated as cost of goods sold divided by the average inventory of the company. Now, the average inventory will be the beginning balance inventory plus ending balance inventory divided by 2. So, for example, for 2015, we can determine the average inventory using 2014 inventory plus 2015 inventory balance divided by 2. Note that cost of goods sold is in the numerator. The reason being that inventory is turned into cost of goods sold. Inventory flows out as cost of goods sold. Now let's also look at the average inventory days outstanding. This measures how many days on average it takes a company to sell its inventory. Now, if the average days outstanding is too long, if this ratio is high, that could be a problem because it will suggest that the company is taking too long to sell its inventories. Now, companies such as Dell, which build to order, would have a relatively higher inventory turnover ratio compared to companies that manufacture in anticipation of demand. Now, companies that manufacture in anticipation of demand could be accumulating inventories in storage in anticipation of demand.